Now, just to get you oriented to the way I measure these things or the way I look at these things, there's a model discovered by a man named Ralph Nelson Elliott in the 1930s, the way stock prices behave. Eventually, this was extended to the way all financial markets behave, and I think it's even deeper than that. I think this is a model of the way social mood fluctuates. The stock price movement is only a result. It is a record of the actions of people whose moods are changing. And every minute, every hour, every day, they're buying and selling on those mood changes. And what happens is it creates a fractal pattern. And Elliott was the first person to notice that there was a fractal in the stock market. Now, unlike the modern mathematicians who have brought fractals into our daily lives by seeing them all around nature, Elliott said, yes, it's a fractal, but it's a specific fractal. It's not a random fractal. It's a specific one and has a certain pattern to it. The reason the market trends is there appear to be 5 waves in the direction of the one larger trend and 3 waves against. When you break that down, you can iterate that over and over again, the very same picture, and you will end up with something that looks the same, is just bigger. Now, it's not quite as simple as that diagram. Much as a tree is not as simple as a bunch of aluminum rods. Trees have a lot of quantitative variability in the way that they can grow and the way the branches can spread out. You couldn't necessarily predict every movement of a tree as it grows, but you could get a general impression and a general forecast of what it'll look like when it's done. Elliott had to describe what waves look like, and in doing so he came up with a lot of rules and guidelines as to the way that you can identify what we're now calling an Elliott wave. We're not going to memorize these at all, but I want to point 2 of them out to show you a picture and how it's iterated. The third wave, that is the middle portion, is commonly longer than the others. And the second arrow points to a rule that says the 2 corrective or downside movements usually take a different shape. And of course, those are all cataloged. But when we take those ideas on the left, you'll see that the middle wave in every case is longer than the others on the rising portion, and that the first decline we have here looks different from the one up on top. If you iterate that a second time and finally a third time, you get something that starts to look just like virtually any financial market you might want to see. And that's accompanying only 2 of Elliott's observations. So we have a model now for how social mood is fluctuating. It's not linear. There's a definite pattern to it, and when it reaches an extreme, it reverses and goes the other way.